The Federal Reserve cut again, and realtors are screaming, refinance now. Bank loan officers are calling you nonstop. But here's what they're not telling you. You could be about to throw away $60,000 or more of your own money. In the next 10 minutes, I'm going to show you the mortgage refinancing trap that's costing American homeowners a fortune. And I'm going to show you the exact math that proves it. Stick around. Hello and welcome back to StockScope Live. I'm your host, Ali, and for months now, we've been telling you something that most people in the financial world get completely wrong. Okay? When the Fed cuts rates, mortgage rates do not automatically fall. In fact, they do the exact opposite. On Wednesday, Jerome Powell and the Fed cut the Fed rate down to about 4.22%. It's a small cut. It is visible on the charts. But the immediate reaction was the 10-year Treasury yield, which directly tracks residential mortgage rates, exploded upwards, not downwards. And guess what happened to mortgage rates? They shot back over 5 and just keep climbing. Now, this isn't accidental. This is not a surprise. This is the exact pattern we've been watching play out for months. But here's the problem. Millions of Americans don't understand this relationship. They see the Fed cut rate and they immediately think mortgage rates are about to go down and they should refinance. So what do? They call their lender, they get super excited, and they start running the numbers. And that's exactly when the trap springs shut, because the math on refinancing is absolutely brutal when you understand what's really going on. Okay, let's start with the fundamental truth that almost nobody gets right. The Fed funds rate and mortgage rates are not directly connected in the way most people think. The Fed fund rate is the rate that banks charge each other for overnight lending. It's a very short-term rate. On the other hand, mortgage rates are tied to the 10-year Treasury yield. That's a completely different animal. It's a long-term rate, and here's the key. When the Fed cuts the federal fund rates, investors who have long-term bonds start to think, if short-term rates are dropping, maybe long-term rates will drop too. But before that happens, maybe I should sell my bond to lock in those current yields. And then what happens when everybody tries to sell their bonds at the same time? The bond prices fall. And when bond prices fall, yields rise. That's just basic math. So the 10-year Treasury yield rises when people anticipate future Fed cuts. Now, residential mortgage rates track the 10-year Treasury yield almost perfectly. So when the 10-year Treasury goes up, mortgage rates go up. And this is the opposite of what the average person thinks is going to happen. They hear Fed is cutting the rates and they assume mortgages will be cheaper. But the reality is Fed cuts often push mortgage rates higher in the short term because the market is trading ahead of what it thinks will happen. We've been talking about telling you this would happen. And yesterday it happened again. The Fed cut rates, the 10-year Treasury exploded upwards and mortgage rates surged. And now we're seeing the desperation play out in real time. As you can see here on the chart, if we scroll a little bit back up, we're going to look at a historical timeline, and you can see that the mortgage rates over the last 5 years have dropped. Sorry, the bank rates have dropped, but the national average has still be 6.32%. Let's look at the refinance index right now. This isn't measuring closed refinances. This is measuring applications, people who are actively trying to refinance. And this number has absolutely skyrocketed since September when the first Fed cut came through. It shoots straight up. As you can see here, right around September 1st, it was at 902. And then it shot straight up to almost 60% higher at almost 1,600. And then it went back down at 1168 and then shot right back up to 1327 after this rate cut. So this is people being desperate. They're trying to save a couple of $100 a month, and they're willing to jump through hoops to do it. But here's what's telling about the market right now. While refinance applications are exploding, the purchase index number of people actually trying to buy homes is also going down. It's falling. It's weak. And this divergence tells you something critically important about what's happening in the housing market. When the Federal Reserve injects itself into markets like this, things don't get better. They get worse. People who already own homes are desperately trying to refinance because they're underwater on their mortgages or worried about affordability. People who don't own homes, they're simply giving up on buying because prices are still too high and rates are too expensive. The system is breaking, and the Fed's solution, which is cutting rates, isn't fixing anything. It's just creating more desperation on one side and more resignation on the other. This is the pattern we've been tracking. Every time the Fed cuts rates, we see the same split. Refinance applications spike, purchase activity collapses. It's not a coincidence. It's a symptom of a broken housing market being made worse by central bank policy. Now, let's talk about the real math, because this is where the trap really springs. And this is why you need to be extremely careful about who you're listening to when it comes to refinancing. Let me give you a concrete example. Let's say you're buying a house for $350,000. You put 20% down. You got a 30-year mortgage rate at 6%. Your monthly payment is about $1,678. Now, let's say the mortgage rate drops to 5%. Same home, same criteria. Your payment should drop about $160. As you can see here, your payment should be now $1,503. That's about $160 per month in savings. Sounds pretty good, right? Here's the problem. The $160 per month is not free money. To get that $160 in monthly savings, you have to pay for it up front. First, there are closing costs. When you refinance, you're essentially taking out a brand new loan. And just like when you bought your home, you have to pay closing costs. Those typically run about 4% of your loan amount. On a $350,000 home with 20% down, your remaining balance is probably around $280,000. 4% of that is about $11,000 in closing costs. That's not a guess. That's what your lender is going to charge you. But closing costs are actually the smaller problem here. The real problem is the amortization schedule. Now, when you took out your loan originally at 6%, you started paying interest. Year one, you paid mostly interest with very little principal. Year two, still mostly interest. Year three, still mostly interest. Now, after 3 years, you've paid down maybe 10% of your principal, but you've paid a lot of interest to the bank. Now, when you refinance to 5%, what happens? The clock actually resets. You start a brand new schedule. You're going back to year one of a 30-year loan. You're going to pay mostly interest again. And here's the kicker. You're going to pay that interest on the entire remaining balance, not on some reduced amount. Let me do the math for you. If you held a 6% mortgage for 3 years and you refinanced into a 5% mortgage, here's what happens over the remaining 27 years. You're going to pay approximately $42,000 more in total interest than if you just kept your original 6% mortgage. That's $42,000 in additional interest payments over the life of your loan. Add that to your $11,000 in closing costs, and you're looking at approximately $50,000 to $60,000 in total costs just to refinance from 6% to 5% after holding loans for 3 years. Now, remember that $160 monthly payment reduction? To break even on a $60,000 refinancing cost, you need $60,000 divided by 160 per month, which equals to about 375 months. That's basically 31 years. So you'd have to stay in the home for 31 years just to break even on the refinancing costs. And by then, your original 30-year mortgage would have been nearly paid off anyway. This is why realtors and loan officers push refinancing so hard? It doesn't benefit you. It benefits them. Every refinance is a payday for the lender. And homeowners who do not understand the math end up throwing away tens of thousands of dollars. There's another perspective that most people miss. Even if you could save $160 per month on your mortgage payment through refinancing, that benefit is completely wiped out by other costs that are rising much faster than your interest rate. Property taxes and homeowners insurance. These costs are skyrocketing. In many parts of the U.S., property taxes have been rising 3 to 5% per year. Insurance is up even more in some areas. If you own a $350,000 home and your property tax rate is about 1% of your home value, and that's a very conservative estimate in many states, your annual property tax is about $3,500 per year, or about $290 per month. Now, if that property tax rises 3% annually on the low end, next year you're paying an additional $10 per month or $120 per year. In 5 years, you're paying an additional $50 per month just in property tax increases. If you add in rising insurance costs, and that $160 in mortgage savings is completely gone. So here's the reality. Even if interest rates fall, even if you refinance, even if you save money on your mortgage payment, you are not actually improving your housing affordability. You're just shuffling money around. The banks get a refinancing fee, property taxes rise, insurance goes up, and you end up in roughly the same place, except you've added more money in refinancing costs to the equation. This is why fundamentals and price matter infinitely more than the interest rate alone. The problem in housing isn't the interest rates. The problem is that homes are too expensive. Property taxes are too high, and insurance costs are climbing. A lower interest rate doesn't fix any of those problems. So what should you do? First, if anyone calls you telling you to refinance because rates are dropping, ask them this question. Show me the math where I break even within 5 years. If they can't show you that, hang up the phone. They're not working for you. Second, before you make any refinancing decisions, run your own numbers. Use the math, calculate the total cost of refinancing versus the monthly savings. Make sure the break-even period is something you are actually comfortable with. Most people will find it's not. Third, and this is the critical question, are you planning to stay in this home long enough to actually benefit from refinancing? Because unless the answer is absolutely, definitely yes, and I mean at least 10 plus years, the refinancing is not worth it. If you found this breakdown helpful, hit the like button and subscribe to this channel. We cover a wider variety of different topics from housing market, interest rates, and what's really happening with your money. Because we know that everyone is struggling right now, and the government is bleeding you for multiple cuts. Make sure you drop a comment below and let me know what does the math look like for your situation. Thanks for watching. Stay informed, stay diversified, and I'll catch you in the next video.